Assalamualaikum. My name is Asma Amira binti Arifin, metric number A24A3151. Now I will present our topic about penalty and default mechanism risk in Islamic banking. Islamic banking and finance refers to financial activities that operate according to Sharia principles. It avoids riba or interest and emphasizes ethical, fair and transparent financial practices. These principles ensure that financial activities are conducted responsibly while protecting the interests of all parties. Moving on, Islamic banks may face risk when customers delay or fail to fulfill their financing obligation. This is important because late payments and defaults can affect the bank's cash flow, profitability and liquidity. At the same time, improper penalty mechanisms may create Sharia-compliant issues and reduce customer trust. Therefore, the objective of our presentation is to examine the causes, impacts and management strategies of penalty and default mechanism risk while maintaining a balance between Sharia compliance and financial sustainability.
So the definition of penalty risk in Islamic banking is penalty risk is actually refers to the risk that arise when the customer fails to make a financial payments on the time, resulting in the application of the penalty according to the Sharia principle. Unlike conventional bank, Islamic bank cannot charge interest on overdue payment instead of they using a Sharia complements mechanism such as tawid compensation for actual loss and the garama penalty for internationally late payment. So now I'm going to explain about the penalty, why the importance of the penalty risk and the cause of the penalty risk and some examples as well so that we can understand about the Sharia law. So why is the penalty risk is important? So it's affect the bank's cash flow and profitability, and it may increase the number of overdue financial accounts. And it's not manageable by properly if it can affect customer trust and Sharia compliance. So cause of the penalty risk. So what are the cause? The late payment caused by customer delay paying their financial installment beyond the due date. So financial difficulty customer may lose their job, experience business losses, or face unexpected financial problem that prevent timely repayment. So what are the examples for this? So the examples are the customer obtain Islamic home financing home from the Islamic bank, and monthly payment is due on the first of the every month. However, the customer pays 2 months late without a valid. So the reason may the bank may impose the tawid to recover actual loss and the garama as the penalty if they delay is international and following Sharia guidelines.
Deferred risk refer to the possibility that the customer fail to make payment according to the agreed term. It occurs when customers are unable or unwilling to pay their financial obligation, such as loan, installment, or arrears payment. Deferred risk can result in financial losses for the company. Customers may defer on their payment for several reasons. The main reasons include financial difficulties, unemployment, insufficient income, high debt commitment, and poor financial management. Unexpected expenses such as medical emergency or family problem can also make it difficult for customer to make their payment on time. The causes of default are mainly related to customer financial condition and economic situation. When customers have limited income but high financial commitment, they may struggle to meet their payment obligations, such as consequent default can cause financial losses and cash flow problems for the company. It may also increase collection costs and negatively affect the customer credit record, while in serious case, legal action may be taken.
Assalamualaikum. My name is Nur Shafqai Sakti binti Rohizat, A24B2934. Will be addressing the impact of penalty and default mechanism based of Islamic financial institution. To set the context, managing default in Islamic banking is fundamentally different from conventional banking. Conventional banks use compounding interest as a punitive tool. In contrast, Islamic banks are bound by Sharia rules. We can only charge taqweed for actual proof loss or garamah, which is a penalty that must be donated entirely to charity. This creates a delicate balance. If our default mechanisms are too weak, we invite moral hazard. If they are poorly structured, we face Sharia and financial repercussions. Let's break down the impact across four main areas. First, financial losses. When a customer defaults, the bank takes a double hit. First default increases our non-performing financial (NPF) ratios, requiring larger provisions that eat into net profit. Second, any garamah penalty fees we collect cannot go into our bottom line. They must be donated to charity. Furthermore, asset recovery in structure like murabahah or ijarah can be protracted and costly, leading to unrecoverable capital. Second, liquidity problems. Banking relies on predictable cash flows. When defaults spike, anticipated inflows freeze, causing acute cash flow mismatches. Because Islamic banks cannot assess standard interest-bearing interbank lender of last resort facilities. Bridging sudden shortfalls require short-term Sharia compliant funding tools, which are often significantly more expensive. Third, reputation damage. In Islamic banking, reputation is capital. If a bank mishandles default penalties, for example, accidentally recognizing penalties fees as income, it's committed as Sharia non-compliance event. This single error can destroy market credibility, trigger regulatory sanctions, and signal to the market that internal controls are weak. Finally, this leads directly to a breakdown in customer confidence. If defaults drive down profits, return to our investment account holders drop. Investors will pool their funds and move to better governed competitors. On the borrower side, unclear or harsh penalty rules drive away ethical clients, leaving the bank with a riskier portfolio. In conclusion, penalty and default mechanisms in Islamic banks are not just a credit control tools. They are core drivers of financial stability, liquidity, and bank survival.
My name is Siti Nur binti Muhammad Zaidi. My metric number is A2483424. Today, I will explain our first risk management strategy. First, preventive measures. The company should set clear credit limits, payment terms, and use legal contracts to reduce payment risk. Second, customer credit assessment. The company should check the customer's credit history and financial condition before giving credit. Customers can then be classified as low, medium, or high risk. Third is financing approval process. The company should have different approval levels and require proper documents or guarantees when necessary. Lastly is predictive monitoring. The company should monitor payments and identify early warning signs such as late or partial payments. That's all.
8. Now, I will present Risk Management Strategy 2, which covers how Islamic banks handle late payments, defaults, and non-performing financing. First, under Islamic penalty mechanisms, the bank uses two instruments, which are ta'wid and gharama. Ta'wid covers the actual cost that the bank has to pay when payments are late, which the bank keeps. Gharama acts as a penalty fine to discourage customers from making late payments. To avoid interest or riba, the bank does not keep gharama as profit. Instead, all fine proceeds are donated directly to approved charities. Second, for debt restructuring, when customers experience real financial problems, the banks step in to assist. This includes extending the financing period to lower monthly installments or changing payment dates based on their current financial situation. This gives customers more time to manage their finances while protecting the bank from heavy losses. Third, regarding collection procedures, banks use a gradual approach. They start with gentle reminders through phone calls or messages to check on late payments, followed by direct discussions to agree on payment plans. Legal action is only taken as a last resort if a customer refuses to cooperate. Finally, under Sharia governance in defaults, the Sharia committee carefully monitors all recovery processes. They make sure penalty calculations are correct and check that gharama money is properly given to charity. This ensures that the bank follows both Sharia rules and Bank Negara Malaysia's regulations.
For my part, I will explain about the differences between conventional and Islamic financing, how Islamic financing avoid riba, and the challenges of musyarakah mutanakisah. First, the difference between conventional and Islamic financing. For conventional financing, the bank lends money to the customer and earn interest from the loan, so it involves riba. Meanwhile, Islamic financing, especially musyarakah mutanakisah, is based on partnership and joint ownership. The bank and customer own the property together. The return comes from ownership and rental rather than interest. Next, how does Islamic financing avoid riba? There are three main ways. First is asset-based financing. The financing is connected to a real asset such as a house or property. So if it's not simply giving money and getting more money in return. Second is risk sharing. In Islamic financing, profit should be connected to risk. This means the party who gets the profit should also take some risk. Third is genuine ownership. In musyarakah mutanakisah, The bank and customer votes on the property at the beginning. Then the customer slowly buy the bank's share until the customer fully own the property. Lastly, there are three challenges in musyarakah mutanakisah. The first is pricing. The return should be based on the real asset and the actual risk. The second is similarity with conventional financing. The monthly payment may look similar to a normal housing loan. So musyarakah mutanakisah must really show partnership and ownership, not just use an Islamic contract. The third is the benchmark issue. Some Islamic banks may still use conventional benchmark to their rental or profit rates. This can make Islamic financing look similar to conventional financing. So in conclusion, musyarakah mutanakisah avoid riba by focusing on real asset, ownership and risk sharing.
I'm Nuraina Maisara bin Muhammad Nazri. My metric number is 2483216, and I will present the critical reflection on the risk management, strategies for penalty and default mechanism risk. Overall, I believe that the strategies discussed earlier are effective in reducing the possibility of customer default, but they cannot completely eliminate the risk. First, preventive measures such as customer credit assessment and continuous monitoring can help Islamic Bank identify high-risk customers at an early stage. Meanwhile, mechanisms such as Tauhid and Gharamah can encourage customers to make their payment on time, while debt restructuring can provide the solution for customers who are facing genuine financial difficulties. However, these strategies also have some weaknesses. For example, a customer's financial situation can change unexpectedly, so even a proper credit assessment cannot guarantee that default will not happen. In addition, excessive collection pressure may affect the relationship between the bank and its customers. One of the main challenges for Islamic banks is to balance financial sustainability with Sharia compliance. The bank needs to protect itself from financial losses while ensuring that penalty mechanisms are applied fairly and according to Sharia principles. Therefore, I would recommend that Islamic banks strengthen continuous customer monitoring, use technology and data analysis to detect early signs of default, provide suitable restructuring options, and improve transparency in applying Tauhid and Gharamah. In conclusion, the strategies are useful, but Islamic banks need a balanced to continuous approach to manage penalty and default risk effectively while maintaining both financial stability and Sharia compliance. In conclusion, penalty and default risk are important issues that Islamic banks need to manage effectively, as they can lead to financial losses, liquidity problems, reputational damage, and reduced customer confidence. Throughout this presentation, we have seen that effective risk management involves both preventive and corrective measures, such as proper customer assessment, continuous monitoring, Sharia-compliant penalty mechanism, debt restructuring, and appropriate collection procedures. The Bank Islam case also shows that clear contractual terms and effective mechanisms such as ta'wid can help Islamic banks manage late payment and default risk while remaining Sharia compliant. Ultimately, Islamic banks need to balance Sharia compliance, customer fairness, and financial sustainability. By strengthening monitoring, transparency, technology, and Sharia governance, Islamic banks can manage this risk more effectively and maintain the trust of their customers and stakeholders. That concludes our presentation. Thank you.